Good morning, this is Kim, and I'm going to go over several of the assignments we had this week in order to prepare you for our upcoming quiz on safe places for money and tax. That quiz will be posted tomorrow, and you will have until online students will have next Sunday to do it. My in-class students will take it this week. Anyway, beginning, I wanted to go through the tax brackets one more time. Specifically, the individual income tax bracket right here proposed for 2015 has taxable income starting at this 0 to $9,225, and that would be at 10%. And again, I want to remind you that we have a progressive tax structure. Progressive means this. If you made $10,000 in taxable income, always the first 9,225 would be taxed at 10%. It is only the difference between 10,000 and 9,225 that would be taxed at 15%. So when I gave you that question about Donald Trump, okay, he's actually married file joint, so he is in this tax bracket. I asked you, he makes $1 million or more. Would he still pay $18,450 of his income at the 10% tax bracket? And the answer is yes, he would. He would pay this amount at 10%, the incremental amount in here at 15%, the amount in between these two dollar amounts at 25%, etc. This $129,000 down here represents all of the tax he paid at each of these preceding tax brackets. That's what that means. So he wouldn't just jump with all of his income at 39.6%. Instead, he paid at all of these brackets first. Then what was over this amount, over 464,000, was taxed at 39.6%. So I want to clarify that because I saw some mistakes on the homework, and I will ask you a test question about that too. So make sure you understand it now. Okay, so with that, I want to have you take a look. This is the Forbes website that's on your course homepage. But down here at the bottom, in addition to the 2015 tax brackets, this is where we picked up the new numbers for the standard deduction: $6,300, married file joint, $12,600, etc. Again, head of household being if you're single parent caring for somebody else, child, qualifying relative, parent, something like that. And there's some phase outs for itemized deductions, but for the most part, they don't apply to any of us in school right now. So I'm not going to touch on that. It just muddies the water and it's not necessary right now. However, I do want to talk about credits, tax credits. Now remember, anything that is a tax credit is applied to our tax return after we calculate tax due. It is a dollar for dollar reduction in tax due. Some of the more popular credits for students include this one, the Earned Income Tax Credit. It's for low, moderate income families, and it's a credit that gives you some of your money back for raising children, or some of you earn this credit because you have one person in the family going back to school, or anyway, it's a very popular credit, Earned Income Tax Credit. Second one, Child Independent Care Credit. Amount of this credit is refundable up to $3,000. Now, I just said a word that's very important, refundable. So let's say you don't owe any tax to the federal government. So when you calculate your tax due, it's effectively zero. But you can still qualify for child independent care credit. Well, that means that the government will still refund you the amount of the credit, even if you didn't owe any tax at the end of the year. So again, it's really important if you're raising children, do your tax return. See if you qualify for some of these credits that you will receive regardless if you owe the government any tax or not. That's what refundable means. They will still refund you part of the credit even if you do not owe tax. Kiddie tax, this is for kids who make money and how much they can make without owing any tax. Adoption credit would be very uncommon for us. These others, again, important. Hope Scholarship Credit, otherwise known as American Opportunities Credit. It is the most powerful credit for college costs because it includes nearly everything you can think of that relates to college. So if you had to buy a computer for college, other types of equipment for college, etc., that would be eligible for part of this credit. And you can see it's tuition and related expenses, books, living, the whole 9 yards, up to $2,000 plus 25% of the next $2,000, which means that the maximum credit is $2,500. Now, you can only use this for the first 4 years of college. First 4 years of college, which this is something we might want to talk about because if you're going to go to City for 2 years and then go to Sac State for 3 years, then we don't want to waste this credit by using it at City College because it's not that expensive. We would rather save this credit and use it when we go to Sac State when we have a lot more expenses and the credit becomes more powerful. But when I meet with you individually, we'll talk about these credits. But right now, I really want you to read them and understand that they are available for you and to help offset the costs of college. And you take them as a dollar for dollar reduction against your tax due. Now, here's a real question. Are they refundable? Is this a refundable credit? So if you don't owe any tax, can you still get some money back? And I'd like you to research that just to determine if they are refundable. Student loan interest deduction. Again, we can take this, we saw this on our adjustments to income, which is right below taxable income. So this would be a deduction, not a credit. A deduction is only as powerful as your tax bracket. Another earned income credit that you might see on a quiz would be something for energy efficiency. So a lot of times if you buy an energy efficient car or some type of appliance for your home or windows, for example, you will qualify for a credit on your tax return. So that is something else that we might have. Okay, so those are credits. Again, at the very end of your tax return, we're going to go to the practice problems so I can make sure you know how to do these. For my online students and for everybody else, your in-class assignment is going to be to complete another practice test. So you are ready for the real thing this week and you understand this material. Okay, let me pop over to homework. I think it's this one that's first. Nope, those were the problems. All right, why don't I just start here with problems. I'm going to go over the problems that were most significant. I probably won't do the time value of money problems, but we'll see. First problem, Thomas Franklin arrived at the following tax information. Question, what would he report as taxable income? Taxable income. Okay, so we're not getting to tax due or anything. We're going to start off using our formula that we talked about in the previous video. We'll start off at gross salary. Well, what are all the salary categories? So we have the first one, 41780, is definitely salary. Plus we have dividend income, which is also part of income for total income. So we're going to add $80. And then we also had this interest income at $225. So I'm looking through this and I don't see any other income categories. So I'll be doing these while I'm going through them. And add this up. So I have 41780 plus $80 plus 225, and that equals 42085. So the next thing I do is I remember that I subtract adjustments. And so my adjustments here, if I look up here, they're 1150. So I'm going to subtract my adjustments. And that'll give me right now equals 4935. And now I know that I'm going to either do, this is my choice right now after I subtract adjustments. I have AGI. That number is adjusted gross income. So I'm either going to take itemized deductions or standard deduction. And I'm always going to go with whatever is larger because I want to reduce my tax gross income as much as possible. So here it's the standard deduction. So I'll go ahead and subtract 6,300, and then I'm going to also subtract the personal exemption because it doesn't matter which way you go, standard or itemized, you always subtract personal exemptions. So let's go subtract 6,300 and subtract 4,000. And that equals 30,635. That is what Mr. Franklin would report as taxable income. Okay, done with that one. I'm just going to make this red, more visible. I'm going to go on to problem number 2. Okay, so the question here is, should she use Schedule A or the standard deduction? Again, standard deduction is $6,300 because she is single. So the first question we're going to ask ourselves is, well, are these Schedule A items? Are these part of itemized deductions? First one, donation to church and charities. Sure, that's on itemized deductions, so that's $19.80. It's included. Medical and dental exceeding certain amount of AGI, that's included too. So add that up. State income tax, yes, part of itemized deductions, $690, and then plus job-related expenses exceeding AGI, and that's also included on Schedule A. So when I add all those, I can tell the answer, but I'm going to solve it anyway. 1980 plus 430 plus 690 plus 1610 equals 4710, which is lower than 6,300. So 4310, I'm going to go ahead and write that out, which is lower than standard deduction. So we take standard at 6,300. Done with that problem. Average tax rate. This is on your quiz. Better know it. Average tax rate equals tax due to the federal government divided by taxable income. Pretty easy formula to follow. So we're going to go 4864 divided by 39,870, and I think that's 12% if I remember correctly. 4864 divided by 39,870, and it equals, rounding a little bit, 12%. All right, done with that. Based on the following information, would they receive a refund or owe additional taxes? Well, again, I'm just following that overall formula, and I'm looking for income categories in here. And I don't see anything specific. So I'm going to move down to my next category, adjustments. And the only thing I see that a starting point here is AGI, adjusted gross income. Bottom line of page 1 of the 1040. So I'm going to start there. I'm going to take 43, 1090. And now I'm going to, do I take itemized or standard? Well, look at itemized deductions. Actually, Anna and Carl Wilton. You think I bet you they're married. So the standard deduction then for a married group I recognize would be double the 6,300. So standard for married, assuming they're filing joint, is 12,600. So which is higher, the 12,600 or the itemized 11,420? Well, it's 12,600. So I'm going to subtract here 12,600, and then I'm going to subtract personal exemptions, and that makes sense. It's 8,000. It's 4,000 for a single, but it's double if you're married. So I'm going to subtract off my 8,000. And that right there, that number is going to give me taxable income. I'll take 43,190, and I'm going to subtract 12,600. I'm going to subtract 8,000. And that equals 22,590. So what do I do now? I know credit is after I calculate tax due. That's federal income tax withheld. Well, that's what my employer took out of my check all year to send to the federal government. So the only thing I have left is, okay, they gave me the tax rate. And if I give you the tax rate in a problem, you do not need to go to the tables. So I'm going to use this tax rate. So right now I'm going to multiply this taxable income by 0.15, which is my tax rate, and I'm going to come up with 3388. Okay, $3,388 is what I owe the federal government. Okay, but I already paid through my employer $67.84. So I recognize right here that I paid way too much to the federal government because I only owe this amount. So effectively, I'm going to receive a refund of the difference here. Subtract 67.84, 33.95. 33.95. That's what the federal government will. Oops, I'm not done here. I forgot about my credit. So I don't owe the government $33.88. I owe the government $33.88 subtract $80. Remember the credit. So what I really owe the government is $33.08. Okay? So now I'm going to receive a refund of $67.84 subtract $33.08. $34.76. That's a lot of money to receive in a refund. I hope you're not thinking that's a good thing, as I'll explain in a minute. Question number 5. This was silly. If this amount was withheld during the year, again withheld like this up here by your employer, and you only owe $33.16, would you receive a refund? Yes. What is the answer? Come on. $34.32 subtract what you owe, $33.16, $116. Number 6. If 400,000 people received a refund of $1,900. Okay, well, how much money is that? 400,000 people received a refund, so I'm going to multiply this times $1,900. Wow, that's $760 million. That's a lot of money. Now let's assume that that amount of money could have earned if these people all did not give the federal government their money all year, and instead they kept their money and they invested it at a rate of 4%. Because remember, lost annual income from savings. So if you overpaid the federal government, you didn't earn any money on that free loan you gave the government. So you lost that money. That was opportunity costs. So if we take this and we multiply it times 0.04, what we could have earned on this money, It amounts to you're not going to believe this, $30 million. $30 million. $30,400,000 in lost interest. Okay. So were you one of those people who gave the government money over the year and then you filed your tax return and you had a refund? Because if you were, I can bet you that the government did not send you a thank you note for loaning them that money during the year. I can also bet that the government did not award you any interest for that loan that you gave them. So, again, I want you to rethink this because you could have upped your withholdings, your withholdings that you sign up for when you start your job. You could have increased that number and you could have had this money in your own pocket and you could have invested it and earned the 4%, or maybe not 4% in this market, but earned something on it. And then instead, you opted to give it away to the government. You let them use your money and hold on to it, and they didn't give you anything in return. So please think about that. Think about that. I will give you a link on the homepage that is a withholding calculator. It's very easy to use and it will help you determine where your withholding number should be so you don't overpay the government. All right, these 8 and 9, these were time value of money problems just for review. So I'm just going to look for the table here. And remember, I always go to the question. She starts preparing her tax return each year. Tax preparer would charge her $60 each year. How much did she gain from preparing her own tax return? Wow. So this is how much does she gain out in the future value, and then it's $60 a year, so it's going to be just future value of an annuity. Here, number 9. This is how they increase the personal exemption amount each year. And it did go up $50 from last year. And there is a formula for it where you multiply the inflation rate times the current amount for the exemption and then round it up to the nearest $50. So if you took $3,100 and you multiplied it by 0.047, I think what would be the amount of the exemption for the next tax year? If I take 31 and I multiply it times 0.047, remember I'm changing that to a decimal. So let's go 3,100 times 0.047, and that it equals actually $145. So I'm going to round that to the nearest 50, which is going to be, or 150, and then I'm going to add that to 3,100. Okay, so hopefully the answer is 3,250. Next question. 11. 11 says, I really need you to listen to this. This is pretty important. So 11 says, you decide to make a $1,000 charitable donation. If you are in the 27% tax bracket, how much will you save in taxes for the current year? I want to start out by saying, let's say, now remember from the table that your first $9,225 is taxed at 10%. So let's say that your taxable income, okay, I'm going to tab over here, and your tax. So your taxable income is $5,000. Well, we know at 10% your tax would be $500. Okay, remember tax is just going to be 10%. Okay, now let's say that you found an adjustment. You found out that you contributed to an IRA that you forgot about. Okay, so now you took an adjustment. An adjustment lowered your taxable income now to $4,000. Okay, but you're still in the 10% tax bracket, but your new tax amount is $400. So So the deduction of $1,000 was equivalent to a $100 tax reduction. Okay, we can see that now. Taxable income dropped $1,000 and your tax dropped $400. The moral of the story is that deductions reduce your tax by the amount of your tax rate or tax bracket. Okay, and that makes sense here. We had a taxable deduction of $1,000. Deduction, remember, and our tax reduced here by $100 or 10%, which in this example was our tax rate or tax bracket. So now for the problem. For our problem, we have a $1,000 charitable donation, so obviously we itemize, and we're in the 27% tax bracket. So how much will we save in taxes for the current year? Well, I just told you our deduction savings in taxes is equivalent to our tax bracket. So we take $1,000 and we're going to multiply it times 0.27, which is going to equal $270 reduction in taxes. Not that hard. But I do want to say one thing. Deductions are as powerful as your tax bracket. But remember, credits are dollar for dollar, so significantly more powerful. Okay, I'm going to stop here. These last two are just time value of money, and I'm not going to quiz you on time value of money again, but I do hope you get a chance to go over this. I'm at 26 minutes right now, so I'm going to close this video and post it and just save it as book problem review. Thanks.